Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for the segment, we have Ben Falcone, Client Portfolio Manager at Vontobel Quality Growth Boutique, to discuss the value of leveraging an international investment approach. Ben, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Pleasure.
You got it. After such a long period of underperformance, why international now?
Yeah, I think it's a really interesting time to be looking at international stocks for a few reasons. One, I think a lot of the artificial drivers of the past decade, and by artificial drivers, I mean loose monetary policy, quantitative easing support, fiscal stimulus, especially during the COVID pandemic. A lot of that backdrop and a lot of those tailwinds are going to become probably headwinds going forward. So that's one. I think also, secondly, inflation is, even though it's coming down, it is going to be somewhat persistent. And so we're going to have rates at a higher level. And what that means for equity markets is that, there's going to be less of a driver to returns that we've seen in terms of multiple expansion. And so you're going to want more businesses that are going to be able to compound earnings year after year after year. That's going to be the driver of returns, in my opinion, going forward. And you can find a lot of those types of businesses listed outside the US, particularly in sectors outside of IT. And lastly, that's really what's been driving, a lot of the market throughout this year. So it's also a nice time to look at it, because when you consider that the top 10 in the S&P by weight have driven about 75% of the returns up until June. So it's a neat time to take a look at international markets, I think.
Are international equities cheap from a valuation perspective?
Jill, they are cheap when you look historically. When you think about coming off of the lost decade around the 2007 to 2010 time period, international markets used to trade at parity with the US. And since then, over the last decade, for some of the reasons that I mentioned earlier, that gap has really widened. And so you do have the S&P on a forward-looking basis trading around 20 times earnings, whereas the ACWI ex-US or the EFA trade more in the 12 to 13 times range.
So why not just buy the index?
A good question. So if you want to buy the index based on valuation, it's trade. Okay. And the reason I say that is because with the index in international markets, you get more exposure to areas like financials. So many European banks, you get exposure to oil companies, more exposure to energy and oil companies, mining companies. And so while those companies can be cheap, they're also the ones that are more susceptible to downturns in the economy. And so you are taking more risk, right, when you just buy the index. So what's interesting too, when you break down the EFA, over the last 10 years, over 100 companies within the EFA have actually beaten the S&P. And so if you find a good active manager, that's the way to go. Many active managers, more active managers have beaten international benchmarks than those in the US.
What are some of the types of businesses that are listed in Europe that you think are quite attractive?
Yeah, that's the interesting part. You can find businesses in different areas that are really the best in what they do. And that, I think, is really the allure to international markets. So businesses in the staples sector, like a Nestle, right? Nestle is has for years invested and positioned itself in faster growing categories. So pet food, nutrition, coffee, and they also have 40% exposure to faster growing emerging markets. Very difficult to replicate their business model with any kind of US staples company. So that's one where they just grow at a higher level of growth rate than typical staples companies. When you look at the luxury space, very exciting. Europe really dominates the global luxury space, and companies like LVMH, Hermes, I would put Ferrari in that category as well. So what do these types of companies have in common? It's really three things. They all control their manufacturing, they all control their point of sale, and they all control their inventory. So over centuries, right, these businesses have been able to sell products at very high prices, at Ferraris at over $400,000 a clip, leather handbags, Birkin bags at tens of thousands of dollars. And so when you're talking about an environment out there where inflation is more persistent, these companies easily pass on prices better than other companies would. And they're less exposed to the economy. So, if the economy goes from 2-3% growth to zero, these companies are less impacted. So those would be ones. And then lastly, I would say a company like an EssilorLuxottica in the healthcare space. They dominate the market for eye lenses, also frames and the retail distribution. So they own Sunglass Hut, Lens Crafters, Grand Vision in Europe. And so when you go in for eye care, it's a one-stop shop. You go into Lens Crafters, you can get you can see a doctor will look at your eyes, and you can come out and you can order the right prescriptive glasses. And when you look around the world, about 4.5 billion people need prescription eye lens wear, and only about 2 billion have it. And 6 billion people, there's 6 billion people in the world that do not protect themselves from UV rays, and those are only getting more harmful. So it's a great business model going forward.
And finally, Ben, any other international businesses to focus on?
Yeah, a couple that I haven't mentioned. Flutter Entertainment's a great one. They own FanDuel in the US, and with online gambling and sports betting becoming legalized in more and more states, that market is going to grow exponentially, and they're the market leaders there. A company called Constellation Software is another great business that really kind of flies under the radar. They're a conglomerate of smaller IT software businesses that are really mission critical in what they do in areas where there's no replacement anytime soon for their mission critical software. So in municipalities, in library management for schools, in reservations for online golf tee times at municipal golf courses, or reservations for public transportation. This is an area where, the typical IT software company in these types of areas might have $5 to $10 million in revenue. They fly under the radar of the big private equity companies, and they've been able to roll up these types of businesses over time. And there's still a much bigger pool of companies that they can buy than what they currently have in revenues. So that's another interesting one.
All right, Ben, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Joe.